Most retirees think the most dangerous bill in retirement is the one they cannot pay. That is wrong. The most dangerous bill is the one they never had to pay in the first place. That is the quiet robbery. It does not arrive with a gun. It arrives with a polite envelope. It arrives as a property tax bill, a Medicare premium, a prescription charge, a bank fee, a utility rate, a state tax line, or a little notary invoice that looks too small to fight. And because the amount looks ordinary, people pay it. That is how the machine wins. I have spent my life studying businesses. I have studied banks, insurers, utilities, railroads, retailers, and governments. They all have different names. But when money is involved, they understand one thing better than almost any individual understands it. Silence is profitable, not ignorance silence. The institution knows the rule. The customer does not ask. The fee continues. The account renews. The bill is paid. The retiree feels poor. The collector feels efficient. That is the first mechanism. I call it the silence tax. The silence tax is money you lose because nobody has an incentive to tell you that you qualify to pay less. It is not hidden under a rock. It is usually sitting on a government website, a bank disclosure, a Medicare page, a utility tariff, or a tax instruction booklet. That is what makes it so cruel. The rule exists, the waiver exists, the exemption exists, the refund window sometimes exists, but the burden is placed on the oldest, busiest, most worried person in the room. The retiree must ask, the senior must know the magic sentence. I am over 65. What am I exempt from? 7 words. I want you to understand what those words really mean. They do not mean, please give me charity. They do not mean, I am helpless. They do not mean, I am trying to get away with something. They mean, show me the rule you already wrote. That is a very different thing. But most seniors have been trained to be polite with money. They were raised not to make trouble. They do not like calling offices. They do not like waiting on hold. They do not want to look needy. They assume the bill is correct because it came from an official looking place. That assumption is expensive. Sometimes it costs $20 a month. Sometimes it costs $2,000 a year. Sometimes it costs a family more than $20,000 across a decade because a county office never said one sentence that would have changed everything. The system does not need to lie to you. It only needs to stay quiet. That is the part that should bother you. A senior can work 40 years, pay taxes, raise children, pay off a mortgage, save carefully, enter retirement with discipline, and still lose thousands of dollars a year because the final enemy is not laziness. It is passive overpayment. I call the second mechanism the passive billing machine. A passive billing machine is a system that keeps charging the full amount until the customer proves they deserve less. Think about that for a moment. If you owe money, the collector will find you. If you miss a payment, the collector will remind you. If a fee is due, the collector will post it. If interest can be charged, it will be charged. If a penalty can be added, it will be added. But if you qualify for a discount, the same urgency disappears. The letter gets vague, the form gets buried, the link gets hard to find. The call center says you may want to check with another department. The exemption becomes your homework. That is not an accident. That is economics in Omaha. I learned early that a business model does not need to be dramatic to be powerful. A bank that collects $12 a month from 1 million people collects $144 million a year. A county that fails to apply a $2,500 exemption to 10,000 eligible homeowners keeps $25 million a Medicare plan that delays a correction by 1 month benefits from confusion. A utility that never advertises a senior rate does not need to cheat. It only needs customers to remain unaware. The first wound is property tax. For many older Americans, property tax is the biggest bill they pay after the mortgage is gone. That is the insult. You spend a lifetime trying to own your home free and clear, and then you discover you are still renting the right to keep it from the local government. Now, I am not here to argue that roads, schools, fire departments, public services cost nothing. They cost money. But most states and counties know that older homeowners can be forced out of their own homes by rising assessments. So they create senior homestead exemptions, assessment freezes, circuit breakers, tax deferrals, or income-based reductions. The names change by state. The danger does not. The danger is that the benefit is rarely automatic. That is the third mechanism, I call it, the application trap. The application trap is when the law gives you a benefit, but the system withholds it until you fill out the right form at the right office by the right deadline. That little form is worth real money. Imagine a homeowner over 65 who qualifies for a property tax reduction of $2,400 a year. That is $200 a month over 10 years. That is $24,000. And the homeowner might lose it because the county never mailed a plain English letter saying you are 65, you own this home, you may qualify. Apply here, and here is the harder truth. A county can know your age, a county can know your address, a county can know whether you own the home, a county can know whether you are receiving the exemption. But knowledge is not the same as outreach. The machine waits, you must move first. The question is not whether every senior qualifies for every program. The question is whether every senior has asked the office that already has the answer. Call the county assessor or auditor. Use the exact words. I am over 65. What property tax exemptions, freezes, circuit breakers, or refund periods am I eligible for? Then stop talking. Let them answer. Do not ask, do you have a senior discount? That is too small. Ask for every exemption, freeze, reduction, deferral, and retroactive claim period. Those words matter because government offices live by categories. The second wound is Medicare. A lot of retirees think Medicare means the government has simplified health care. That is a sweet thought. It is also not reality. Medicare has premiums, deductibles, drug plans, supplemental policies, co-pays, income rules, assistance programs, enrollment windows, penalties, and letters that look like they were designed by someone who never wanted to be understood. Inside that maze are programs that can reduce or eliminate certain Medicare costs for people with limited income and resources. The official names sound like they were built to repel ordinary human beings: qualified Medicare beneficiary, specified low-income Medicare beneficiary, qualifying individual, extra help, state health insurance assistance program. A retiree hears those names and thinks, that sounds like paperwork for someone else. That is how money leaves. The important question is simple. Could your income and resources qualify you for help with your Part B premium, certain deductibles, co-pays, or drug costs? If yes, the savings can be larger than people expect. A Medicare Part B premium alone can run over $2,000 a year. If a person qualifies for help and does not apply, that retiree is effectively writing a check every month for a benefit that may have been available. That is not prudence. That is a leak. I want to be very clear. These rules vary income. Limits change, asset limits change. Some states are more generous than others. Certain income may be counted differently. A person who looks ineligible from one rough number may still qualify after proper screening. That is why guessing is dangerous. Call SHIP, not a salesman, not a random television advertisement. SHIP stands for State Health Insurance Assistance Program. It exists to help people understand Medicare choices and assistance programs. The question is blunt. I am over 65. What Medicare savings programs or drug cost assistance programs should I be screened for? That one call can be worth more than a year of clipping coupons. The third wound is prescription drugs. This one is especially dangerous because it hides inside fear. A senior reaches the pharmacy counter. The clerk says the drug costs $240. The senior hesitates. Maybe they fill half. Maybe they delay it. Maybe they say, I still have some left at home. Maybe they pretend the doctor told them it was optional. That is not budgeting. That is medical surrender. The rules around Medicare Part D changed. There is now an annual out-of-pocket threshold for covered Part D drugs, adjusted by year in 2025. The major headline was a $2,000 cap for 2026. The threshold is higher, around $2,100 under federal program instructions. Once a person reaches the applicable threshold for covered Part D drugs, catastrophic coverage changes the math for the rest of that calendar year. The big lesson is not just the number. The big lesson is tracking. You cannot manage what you do not track. I call this the threshold fog. The threshold fog is when a retiree is close to a cost limit but keeps making decisions as if every next prescription will cost the full amount forever. That fog can make people delay care, skip refills, or pay charges that should be questioned. Call the Part D plan before the final months of the year. Ask for the year to date out. Pocket total toward the annual threshold. Ask what happens after the threshold is met. Ask whether any pharmacy charges after that point were processed correctly. Ask how to request a review or refund if something looks wrong. The fourth wound is state income tax. Federal taxes get the attention. State taxes often do the quiet damage. Many retirees do not understand how their own state treats Social Security, pensions, IRA distributions, military retirement, public pensions, private pensions, and age-based deductions. They either assume everything is taxable or they assume nothing is taxable. Both assumptions can be wrong. The real rules are usually printed in state instructions nobody wants to read. A state may exclude Social Security. Another may tax it but phase out the tax under certain income levels. Another may exempt a portion of pension income. Another may offer a retirement income exclusion after a certain age. Another may treat government pensions differently from private pensions. This is where overpayment happens quietly. A retiree uses tax software. The software asks a few questions. The retiree clicks through. A preparer who is busy in March enters numbers quickly. The state form is filed. The refund looks reasonable. Nobody asks whether the retirement income exclusion was properly claimed, and the state keeps the difference. I am over 65. What retirement income exclusions, Social Security exclusions, pension deductions, or age-based credits apply in my state? Ask your tax preparer. Ask your state revenue department. Look at last year. S-return, compare the exclusion line with your retirement income. If an exclusion was missed, ask whether an amended return is available for prior years. The refund window is the fifth mechanism. The refund window is the limited period when the government may still give money back if you prove you overpaid. A missed exemption is bad. A missed exemption after the refund window closes is worse. Then the money is not just overpaid. It is gone. Time matters. That is why waiting is expensive. The fifth wound is utilities. Heating a home is not a luxury. Cooling a home for an older person in a dangerous summer is not a luxury. Electricity, gas, and water are not lifestyle choices. They are survival infrastructure. That is why federal, state, and utility-based programs exist to help certain households with energy costs. One of the major programs is LEHEAP, the Low-Income Home Energy Assistance Program. The rules vary by state, and eligibility can be based on income thresholds tied to the federal poverty guidelines or state median income. In some places, seniors who think they earn too much may still qualify because the applicable threshold is higher than they assumed. That sentence is important. Many people do not apply because they reject themselves. They say, I probably do not qualify. Probably is not a financial plan. A utility company may also have senior rates, low-income discounts, budget billing, arrearage programs, medical baseline programs, weatherization assistance, or hardship credits. Some programs are run through the utility, some are run through community agencies, some are run through state energy offices, some are seasonal, some run out of funds. That last part matters. A program can be real and still be unavailable. If you ask too late, the utility company knock on every senior's door and say, we may be able to reduce the bill you have been paying us for years. That would be bad for revenue. So you ask, I am over 65. What senior rate, low income rate, budget billing, LEHEAP referral, weatherization, or hardship program can I apply for? Do not accept the first vague answer. Ask for the department that handles assistance programs. Ask for the application link. Ask what income documentation is needed. Ask whether the program renews automatically or requires annual recertification. A utility bill reduced by $50 a month is $600 a year. A $100 monthly reduction is $1,200 a year. That is not minor to a retiree on a fixed income. That is food, medicine, insurance, repairs, and breathing room. The sixth wound is bank fees. This one irritates me because it is so ordinary. Banks are very good businesses when run well. I have owned bank stocks. I understand the model. Deposits are valuable. Fees are valuable. Customer inertia is valuable. But as a customer, you must understand the same economics. A bank loves an old account that never moves. A senior opened an account 30 years ago. The account has an old fee schedule. Monthly maintenance fee hits quietly. Maybe $7, maybe $12, maybe $25. The customer does not complain because it is familiar. The bank does not volunteer a cheaper account tier because the customer did not ask. That is inertia revenue. And inertia revenue is one of the most beautiful revenues in capitalism if you own the business, and one of the most foolish expenses if you pay it unnecessarily. The question is simple. I am over 65. What senior account tier, fee waiver, balance waiver, or no fee account can you move me into today without closing my account history? That last part matters. You do not always want to close an old account carelessly. You want a review, you want a migration, you want a fee waiver, you want to preserve what needs preserving and eliminate what needs eliminating. The seventh wound is notary fees and small administrative charges. This sounds too small until you understand the pattern. A retiree needs documents notarized, power of attorney, healthcare directive, deed, estate planning documents, beneficiary paperwork, maybe a bank form, maybe a county form. They drive to a private notary and pay $15 here, $25 there, $75 for a batch. They assume that is just what it costs. Sometimes it does, sometimes it does not. Banks, credit unions, libraries, senior centers, county offices, and public agencies may offer free or low-cost notary services for account holders, patrons, residents, or certain document types. The rules vary, availability varies, but the question costs nothing. I am over 65. Do you provide free notary services for account holders, seniors, residents, or documents filed with this office? That is not a glamorous sentence. It will not make a thumbnail explode, but it may save money, reduce hassle, and prevent a senior from paying private fees for a public or account holder service already available. Now step back and see the whole machine. This is not 7 separate tips. That would be too weak. This is one operating system. I call it the Senior Exemption Audit. The Senior Exemption Audit is a yearly review of every institution that takes money from you, with one question attached to each account. I am over 65. What am I exempt from? You ask the county, you ask Medicare, you ask the drug plan, you ask the tax preparer, you ask the utility, you ask the bank, you ask the credit card issuer, you ask the library or county office before you pay notary charges. You ask every insurer, every membership organization, every local agency, and every office that sends a bill. You do not need to be rude, you need to be precise. The system respects precision, and you must document everything. I want a notebook, a folder, or a spreadsheet. Nothing fancy, the institution, the phone number, the date called, the person spoken to, the exact question asked, the answer the form required, the deadline, the confirmation number, the renewal date, the expected savings. That is how adults protect money. Memory is not an operating system. Hope is not an operating system. A drawer full of unopened letters is not an operating system. A retiree who has worked a lifetime deserves more than vague confidence. They deserve control. Here is the identity flip. You are not a bill payer anymore. You are the auditor of your own retirement. That is the turn. A bill payer opens the envelope, sighs, and pays an auditor, opens the envelope, compares it to the rule, asks for the waiver, checks the threshold, tracks the deadline, and keeps the confirmation. The bill payer trusts the machine, the auditor tests the machine. That difference can be worth thousands of dollars a year. I do not say that lightly. When you are young and working, you can sometimes out-earn small mistakes. When you are retired, small mistakes compound against you. A fee you ignored at 45 was annoying. A fee you ignore at 7, the fifth of maybe medicine, heat, groceries, or the ability to help a grandchild without fear. That is why this matters. And let me give you the harder judgment. The institutions collecting these fees are not evil in the comic book sense. They are worse than that. They are rational. Rational systems do not give back money unless the rules require it or the customer asks with enough precision. That is why I never build a financial life around the kindness of a billing department. I build it around rules. If you qualify, apply. If you overpaid, amend. If you are near a threshold track, if a fee appears, if a program renews calendar, if a document is needed, keep it. If the office says no, ask what rule they are relying on. That sentence is powerful. What rule are you relying on? Not, why are you being unfair? Not, I saw a video. Not, my neighbor said ask for the rule. People behave differently when asked to identify the rule. A vague no sometimes becomes, let me check. A call center answer sometimes becomes a supervisor answer. A supervisor answer sometimes becomes a form. A form sometimes becomes a reduction. A reduction sometimes becomes a refund. This is not magic. It is procedure, and procedure is where money hides. Now, I want you to understand the accounting. Suppose one senior saves $1,800 on property tax, $2,100 on Medicare premiums or drug costs, $600 on utilities, $180 on bank maintenance fees, $250 on a card fee, $120 on notary and administrative charges, and $700 through a state tax correction. That is $5,750. That is 1 year. If that continues for 10 years before any investment return, it is $57,500. If even part of it is invested, saved, used to avoid credit card debt, or used to pay for preventive care, the real impact is larger. And if the number is smaller, it still matters. A $900 annual savings is not small if your retirement margin is $200 a month. Now, I want to put this into a simple protocol because without a protocol, a good idea dies after the video ends. Today, write down every monthly bill and every annual bill. Not tomorrow, today, property tax. Mortgage escrow if it includes property tax, Medicare premiums, Medicare Part D plan, supplement plan, utilities, state taxes, bank accounts, credit cards, insurance, phone, internet, memberships, notary or legal document costs, anything that takes money from you. Then mark the ones controlled by law, regulation, tariff, account type, contract, or public program. Those are the ones to audit first. Tomorrow, call the county assessor or auditor. Ask about senior exemptions, freezes, deferrals, circuit breakers, and retroactive refund periods. The next day, call SHIP and ask for a Medicare savings program and extra help screening. The next day, call the Part D plan and ask for your year to date out of pocket total toward the annual drug threshold and whether any charges were misprocessed. The next day, review your state tax return or ask your preparer whether every senior Social Security, pension, and retirement income exclusion was claimed. The next day, call every utility and ask for senior rates, income-based rates, LEHEAP referrals, budget billing, weatherization, and hardship assistance. The next day, call the bank and credit card companies, ask for senior tiers, maintenance fee waivers, retention credits, and no-fee downgrade options. The next day, call your bank, library, county recorder, or senior center and ask where notarization is free or low cost. 7 days. That is the audit. Do not make it more complicated. The reason people do nothing is not because the work is impossible. It is because they let the whole pile sit in one frightening heap, break the heap into calls. One call can change a year, one form can change a decade, one question can interrupt a machine that has been feeding on silence since the day you turned 65. And if you are not over 65, do not dismiss this. Your parents may be, your neighbor may be, the woman at church may be, the man who helped you when you were young may be, the uncle who never complains may be, the friend who says he is fine but has stopped going out to dinner may be. This is how quiet financial pressure looks in old age. People do not always announce it. They shrink their life instead. They lower the heat. They skip the trip. They delay the dentist. They stop buying the good fruit. They say, I do not need anything. And everyone around them mistakes sacrifice for preference. Sometimes it is not preference. Sometimes it is overbilling. Sometimes it is an exemption never claimed. Sometimes it is a form sitting on a website nobody told them to open. That is why this is not a soft topic. This is hard money. This is retirement defense. The next time a bill arrives, I want you to see it differently. Do not see a command. See a claim. The institution is claiming you owe that amount. Your job is to verify the claim against every exemption, waiver, cap, discount, exclusion, and refund window available to you. That is the proper relationship, not rebellion, verification. And if anyone makes you feel foolish for asking, remember this. Large institutions ask for their exemptions every day. They ask for abatements. They ask for credits. They ask for subsidies. They ask for rate treatment. They ask for deductions. They ask for special rules. They hire professionals to ask harder and faster than you ever will. So do not let anyone tell you that your question is improper. The most expensive person in retirement is the polite person who pays without checking. The safest person is the quiet auditor who asks every year, I am over 65. What am I exempt from? Those 7 words are not a slogan. They are a key, but a key does nothing in your pocket. You have to use it. So here's the final test. Before another month passes, pick up the phone and ask one institution, just one. Do not wait until you have the perfect list. Do not wait until tax season. Do not wait until the next open enrollment period. Do not wait until the next bill shocks you. Ask now, because every machine that profits from your silence is counting on one thing. It is counting on you being too tired, too polite, too embarrassed, or too trusting to ask the question. Prove it wrong.